G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and what I love doing is bringing guests who are what we call best in breeds. We're talking about real industry advocates. We're talking about people that are thought leaders in the property space. And today's guest, I always say we're in for a real treat, but today's guest is someone that's is going to be a wealth of knowledge, and I'm going to say it, a real mover and shaker in the property space. Terry Ryder, welcome to the show.
Hi, Aaron. Great to be here. I haven't been called best in breed before. Some people would question my pedigree, but we shall see. We usually are able to provide good information about the housing market around Australia.
Yeah, okay. Look, best in breed is one thing, but I think you've ruffled a few feathers over time. You know, you've gained quite a reputation for yourself. I mean, when you look back at your tenure, here you've been in the industry for quite some time. So naturally, you've got some frenemies, you've got some people that love what you're doing, and you've got some people that, that maybe speak the exact opposite of what you're trying to put out there. And that's often a good thing. I think it's a healthy debate when you're raising topics that lead to a discussion as well. But if I look back at your journey, you've had roots in media, in property, for example, and now starting hotspotting since 2006. So what I'd love to do is kind of go back to the Terry Ryder story and tell us, how did this all unfold and how did you kind of get you started into property?
Yeah, well, I was born and bred in a very small town in New Zealand, came to Australia for a working holiday in 1978 and never left.
Yeah.
Loved the lifestyle, the climate, and stayed. And I was working in newspapers, working at the Courier Mail newspaper in Brisbane. And one day I got called in by the editor and said, "We've decided to make you property editor." And I said, "But I don't know anything about real estate." And he said, "That's okay. You'll find out. It's about houses and stuff," which is kind of typical of the way, it's just something that the way newspapers are run. Not too many people who are expert in the fields in which they're writing, unfortunately, in Australian media.
Yeah.
Anyway, I decided if I was going to be property editor, I'd find out as much as I could about real estate. So it kind of evolved into, firstly, a specialty as a journalist, and then later I left newspapers and became a consultant to the property industry, doing research and writing reports, which sort of combined two of the things I really enjoy doing. And out of that evolved eventually the business that I have today, which has the brand names Hotspotting, which the company's Ryder Research Resources.
Yeah, great. I mean, anyone that's been around for some time in the property space, I know, and when I looked through your bio, Property Observer was probably one of the resources that I probably came across your name years ago when I worked inside a bank, for example, and I felt like you were just putting information out there that was quality, high caliber information, but also you'd kind of cut through the BS when it came to investing. Do you feel, is that something that you wear as a badge of honor, for example, and a bit of that straight talking type of mindset that you've got?
I think it's really necessary. I think we should see more of it. Far too many people rely on news media for information about real estate, and it's just so much BS, as you say, in media, a lot of misinformation. Unfortunately, most of the people writing about real estate media aren't experts, and many of the people they quote, who they use as experts, actually aren't experts, particularly economists, bank economists. They've got a terrible track record of understanding and forecasting housing markets in Australia, because I just don't think they get it. It's not really their area of specialty. So the consequence of that is that media is full of misinformation, as I see it. And so I call it out where I see it with my various broadcasts and podcasts and webinars and writings, because it's kind of dangerous for people as consumers if they're making the biggest decisions financially that they will ever make based on really bad information. And it's a danger. And so we're trying to fill a gap there by providing people with good analysis and good information from a honest and ethical viewpoint, but based on a lot of hard work and research. We've got a team pouring through sources every day, gathering information that populates the reports that we produce.
Yeah, I love it. I mean, having switched over, so you've been in the media side, and I'll tell you where I'm going in a second. We'll get maybe some media inquiries to go, look, find us a client who's struggling, for example, give us a bad news story. I'm like, we don't really have anyone that's kind of, on their butt at the moment, struggling to make repayments, with all the rate rises that we've had. There's nothing here to see. And they'll keep going, I guess, till they find the story that they're looking for, which ultimately gets eyeballs and headlines, which then is how publications run. Do you think being through there is kind of, I don't want to use the word cynical, but do you feel like, you talked about misinformation, do you just feel like these are headlines that are being pumped out purely to get attention, purely to kind of ruffle a few feathers as well?
Yeah, absolutely, I do. And what the syndrome you referred to is so true, particularly now. When I was a journalist, in simple terms, there were two types of media. When back in the day, when I was a newspaper journalist, there was quality newspapers, those who tried to be quality, with an ethic of being accurate and fair and balanced. And there was the tabloid media, which was the beat-up sensationalist type media. Yeah. But now, in my view, it's all sensationalist media. Even the Australians, the Australian Financial Review, those types of previously quality media, and now it's tabloid media as much as anywhere else. And it's all about clickbait, and it's all about the headline. So what you referred to earlier is so true, in that if you present journalists with 95 out of 100 things that are positive, they'll focus on the 5 things that are negative and make that their headline. And we see that constantly with price data that comes out. More interested in the ones that are going backwards than the ones that are going forwards, even though the growth markets might outnumber the negative ones by 10 to 1.
Yeah.
So, we try to present information that sort of balances that out and give people a source of quality information without the prerogative of trying to induce people to clickbait on things. So, a different mindset. I don't think media is motivated by a desire to help anybody. They're not trying to provide us with good information. They're not trying to assist us. They're more inclined to be trying to startle us, to induce us to click on things. We don't have that motivation. So I think we're a better source of data. But sadly, I don't think that many people realise that what they get from media is not quality information.
Mm. Yeah, I mean, it's a confirmation bias as well, as what I find is when you're looking for that type of information about the property market going backwards, or the fixed rate cliff that was going to catapult the market into a double-digit falls, for example, or the rising number of defaults, for example, or families that are doing it tough with all the rate rises. And then we look at the actual data on what we're seeing at the moment with the amount of people that actually are behind on repayments or missed payments or arrears, which are 3 all very different metrics, for example. And then what the actual reality is, that people are, there's quite a few number of people that are ahead on their repayments, and it's a non-event, but somehow we're kind of fishing for these stories, and that's the echo chamber that people are kind of going, well, look, see, property prices are about to fall because there is, 1 in 250,000 that are behind on their mortgage repayments.
Yeah. Media loves a cliff, don't they? And they invent them, but they never happen. Subsequent events prove them to be false.
Yeah.
But it's dangerous for people, and it costs people. And an example of that is when COVID struck in 2020, and media was telling us that prices were going to collapse, and a lot of people who had planned to buy at that time decided not to because they believed that prices were going to drop 20 or 30%. And of course, in 2020, prices rose. By the time people realised that actually what we had was the opposite of a collapse, we actually were moving into a boom, they'd missed out on maybe 100 grand's worth of capital gains had they gone ahead with the purchase they planned until they allowed media to change their mind. So it's unfortunate, and unfortunately the average punter out there is as a herd animal. They do tend to follow the pack rather than make decisions based on good research and their own strategy and moving ahead with it regardless of what others are doing. The successful investors in any sphere, not just real estate, but if you look at the truly successful people around the world, they're very counter-cyclical in their thinking. When others are selling, they're buying, and vice versa. They're certainly not moving in the same direction as the herd, or at the very least they're leading the herd.
Yeah, great. So take me through a little bit about your own journey. I mentioned when you started out, you were trying to learn more about property. How's your property journey unfolded? I'm not asking you to divulge every detail of your portfolio, but how has your journey unfolded, and when you look back on your journey, what are you most proud of in terms of building your own portfolio?
Look, it started in the early 80s when I got tired of the problems of being a renter, a tenant, and decided the only way I could escape that was buying my first home. It was, in some respects, a little bit easier, in other respects, a little bit harder back then. But once I decided to do it, I just poured everything I earned into saving to get that deposit and buy my first home. And a couple of years later, I sold it for a decent profit and moved closer to where I wanted to be, which was towards the middle of Brisbane, because I was then working in newspapers in central Brisbane. And for a while, I thought that the way to progress was to buy something and then sell it and then buy something better. So trading. If I could go back and give the 25-year-old me some advice, it would be, don't sell, keep those good assets. If I still had some of the property I bought back then, I'd be substantially wealthier than I am now. But what am I proud of? That I've been able to buy good real estate based on sound research. I mean, I've never lost money on a piece of real estate. Many people have tales of woe where they chose badly and lost money and had to start again. I haven't had that experience. I've always bought real estate that has a saleable quality about it in good areas based on what I believe to be true in terms of what makes real estate outperform. And that's always served me pretty well.
So when you look back at it, I mean, you didn't know what you didn't know then. So how did you make good quality property decisions at that stage with your limited knowledge?
I think it was just instinct, but also I think more particularly talking to people, because once I was surprisingly appointed property editor at the Courier Mail, these days media consists of journalists sitting at their desk and receiving press releases and rewriting them. That's pretty much journalists these days. But in those days, if you published a press release, you'd be sacked. What you had to do is get out and go and talk to people in the industry who knew things and build relationships and find out what's going on before anybody else did. So that's how I became knowledgeable about real estate, just going out and talking to people. And that's what I spent 90% of my time doing. And over a period of years became more and more knowledgeable and understood some of the things that drive prices upwards, and learnt that real estate has a particular place in the culture of Australia, and that most Australians have a belief in the solidity and safety of real estate, and that's one of the reasons why we get real estate outperforming the pessimists time and time again. It's something you can't factor into a formula or an algorithm, but it's very much a big part of what drives prices forward in Australia. Property seems to do really well in times of disruption, in times of struggle. Those, and global financial crisis, the COVID disaster that was supposed to be predicted by the economists, but didn't happen because I think people retreat to the safety of real estate when times are uncertain. That's another of those reasons that makes it so solid and safe.
Yeah, and you mentioned just earlier that that the Australian market has enjoyed sustained success, for example, over a long time. Do you look at the current market and just go, look, is it out of reach? Is it unaffordable? Is it unattainable for younger Australians? What's your view on that?
Look, I don't think it's nearly as dire as media would tell us. That they love the story, the headline, which says young Australians are doomed to a lifetime of renting. That has become increasingly unattainable. And then they'll roll out statistics that are kind of irrelevant to the average first home buyer. That the median house price in Sydney, a 20% deposit, which you don't need. Never apartments, always the most expensive options. Look, it's certainly in our biggest cities, it's quite hard. But there are options. There are ways for people to get into real estate. You can become a rent investor, for example, if you choose or need to be in, the inner city suburbs of Sydney or Melbourne where you can't afford to buy. You have options like renting where you're living and buying real estate in a more affordable area to get started, or you could go for some of the more affordable options within those big city areas like apartments and townhouses, for example. And more people are making that choice to get started, because in the inner west of Sydney, where you might be paying $2 million for a house, you can access apartments for 600,000 or 700,000 in some of those suburbs. So there are affordable alternatives, and I've had conversations with more and more young people who have made the choice that with what I do, I can be anywhere because of technology.
Yeah.
I don't have to be in Sydney or Melbourne or Brisbane. I can move to a regional area with a more relaxed lifestyle and buy a home that's more affordable, and I can still have the same job because I can work remotely. So all those options are available to people to overcome the affordability problem.
I love it. Yeah, great sentiment. Thank you very much. I tuned into one of your articles that you put out there, and I'll read the headline: "No better time for investors to make their 2024 move." And look, I personally love the sentiment, and I think one of the research sources that you've cited, KPMG has forecast that prices nationally will rise about 5% from now until June 2024, and then 9 to 10% in the 12 months to June 2025.
Yeah. Secure on the knowledge that those forecasts are always incredibly conservative. We're at that time of the year where people are making their forecasts for next year, and they're always pessimistic in terms of what the final outcomes are. And we've seen that at the beginning of every year for the last, go back as far as you like, but certainly the last 4 or 5 years. We've started this year, for example, with most economists telling us prices would fall 15% or at least. And of course, we've had prices rising quite healthily this year.
Yeah.
So the usual suspects are making their forecast for 2024, and they're very conservative. We're more optimistic without being silly about it. We think it's going to be a year in which we're going to see pretty good growth, similar to this year, I think. And the rationale in saying, it's never a better time to get into it, from the viewpoint of an investor, it's to do with, I suppose, if I can sum it up in one word, shortage is the key word at the moment. And the fact that we have shortages of everything that matter in real estate is why we've had rising prices, and indeed strongly rising buyer activity at a time when interest rates have been rising and borrowing capacity has consequently been reduced. We don't have enough rental properties, obviously. That's been the case for a number of years, and it's going to get worse before it gets better. We're not building enough new homes. We just don't have the capacity in the country. The resources just aren't there to build as many homes as the federal government says they would like to. We don't have enough properties on the market for sale. So all of that puts upward pressure on prices and rents and overcomes the negative of higher interest rates. And it's all happening at a time when we have very high levels of population growth, boosted by record levels of overseas migrants coming into the country. So it's very hard to see prices doing anything but rising further next year in most places. One of the things about Australia is we don't have an Australian property market. We have lots of local markets, and we don't have a situation where every location is doing the same thing. We have multi-speed markets, and that's normal in Australia. So we have some locations that will rise strongly next year, some will rise moderately, some will fall a little bit, some might fall a lot. Right now, for example, Sydney, Brisbane, and Melbourne are very strong, and that will continue into next year, whereas Canberra and Darwin are very weak. And Perth, which has been the strongest market for the last couple of years, is starting to come off the boil based on our analysis, although no one else seems to have picked up on that just yet. But the sales activity in the latest quarter we've analysed has fallen away quite sharply in Perth. So,
why do you think that's the case? Yeah, because everything that I'm seeing at the moment, where a lot of buyers agents are advocating for, it's all pointing to Perth at the moment. And you're saying, look, our research is indicating otherwise. So what are you seeing there that others aren't, for example?
Well, until very recently, we had a similar message. Perth has been the strongest market in the country.
Yeah.
Just in our latest, we've just analysed all the figures, sales activity for September, and it's the first sign we've seen that Perth has peaked and is starting to taper off a bit. The sales activity was much less in the September quarter than the previous quarters. And that's inevitable. It's been a growth market for 3 years. It can't continue ad infinitum. And so we're just starting to see it taper off a little bit. So it's going to be, now we have a situation where the strongest markets are, well, in terms of the way we rank them in the price predictor index that I do this research for, a quarterly report, Melbourne number 1, close behind Brisbane and Sydney, and then we've got regional Queensland, regional South Australia as number 4 and 5.
Yeah, right.
Regional Victoria still quite strong, regional Western Australia quite strong, but Perth tapering off. Adelaide continues to be very consistent, and Canberra and Darwin are quite weak. Not a coincidence that they have the 2 weakest economies in the country, according to CommSec State of the States report. So there's probably a correlation there. So multi-speed markets, that's normal.
Yeah.
That's what we'll see in 2024, I think.
Beautiful. Just go back to this article as well. One thing that really kind of stood out to me is investors who worry that prices have increased too much to get into the market are looking in the wrong spots. Can you just elaborate a little bit on that more for us, Terry?
I mean, Australia's such a big country. There's always other options. People sometimes fixate on a location, like many people are fixated on Perth. And what we've been saying to people is, until very recently, it has been an incredibly hot market, and too hot, in fact, because if you want to buy sensibly and do your due diligence, you're going to miss out because properties were selling so quickly.
Yeah.
And I thought that was quite dangerous, that some people are going to end up with properties that have got some big problems, but they were in such a hurry to beat the competition, they bought in haste and they didn't do all the checks and balances that they should have done. So we've been saying to people, look, there are other places you can go. You're going to get good long-term growth. They've got the credentials for growth, but are perhaps a little bit less competitive, and you don't have to act quite so quickly. You can, do a little bit more due diligence and buy more sensibly. So that there are always options in this country to buy in places that, tick the boxes for whatever the criteria for the investor. It might be they want to buy in a particular price range. They might be prioritising above average rental yield because interest rates have risen. They're looking for a place that's got a strong, diverse economy, creating jobs, infrastructure spending is happening, and so the criteria is there for future growth. There are lots of places at any point in time like that around Australia to choose from.
Yeah, nice. Thanks very much for sharing. Another stat that really strikes me is the number of investors that crack the 5 properties plus, 6 properties plus, for example. I'm calling this the glass ceiling, and what I feel is people that maybe haven't been able to crack a certain number of investment properties. Now, we're not here about vanity metrics in terms of quantity over quality, so I want to be very, very clear about that, for example. So I think this is purely about trying to hit a certain number, you've missed the point. But what we are saying is some people are actually very capable. They've got the equity and they've got the borrowing capacity. Why are they not pulling the trigger in terms of succeeding in investing in property? And that's one question I've got for you, Terry, which is you've done this for quite some time. What have you seen the great investors do? What have you seen the mediocre investors do? And what do you see the poor performing investors consistently do as well?
Yeah. Look, I mean, the statistics that you're referring to show that about 72% of people who have an investment property just have one, and fewer than 1% have 5 or more, what you might call a portfolio. And it's quite startling. Why do so few people get beyond 1 or 2 properties? And I think it's because a number of reasons. The people who do succeed are people who are able to act and think independently. They're not herd animals. They have sat down and thought about it and developed a strategy. They understand what their objectives are and they've got a strategy for getting there. And then they have the ability to make decisions, to move forward, regardless of all the white noise in the media, regardless of the predictions from the economists. They've got their plan and they're going to implement it, taking a long-term view. Well, most people really struggle to make decisions, and I'm coming up against this brick wall with clients and potential clients all the time, is that people are fearful of making big decisions, and they can very good at coming up with reasons not to make a decision. I want to wait and see what the Reserve Bank decides next week. I want to wait and see the result of the federal election. There's always a wait and see option for people who, and you might go back to them 6 months later and they haven't moved forward one iota. They're still stuck in the same spot. And that's most people, I think. But the ones who succeed are able to make decisions and implement them. But probably the biggest single difference is the willingness to invest in advice and information, because most people aren't.
I mean, information, to invest in information, for example, there's no shortage of info out there. I mean, podcasts, we're guilty of that, for example. You've got white papers, you've got research, you've got CoreLogic data, you've got YouTubers, you've got there's no shortage of resources. Do you think it's a shortage of resourcefulness, or do you feel it's like analysis paralysis, not knowing who to trust? Like, is it a combination of all the above? Where do you find that hesitation coming from?
There's almost too much information out there for them, and it's really, really hard to know what to believe, who to believe.
Yeah,
and it's one of the secrets of the success of people who have got portfolios and constantly adding to them, is that they, we often say to people, build your team before you build your portfolio. And I think it's a really important little catch cry that people should write down and put on the wall of their office and look at it every day. Build your team before you build your portfolio. The people who succeed have around them good financial advisor, good mortgage broker that they've used for years and they trust, sources of good information, mentors. Successful people have mentors. I have mentors. I mentor people, and I have mentors, and my mentors have mentors, and the process never stops for people who know how to succeed with this thing.
And learning never stops as well, right? We're constantly evolving, constantly learning.
Oh, that's right.
Yeah.
Those are the characteristics, I think, that distinguish the people who do succeed, as opposed to those that don't. They're willing to invest in themselves, and that means invest in learning and never stop learning. I might use as a case study a guy that I know. His name is Guy, actually, based in Sydney. He's got his own business in the Northern Beaches area of Sydney. That's his day job, but he's got a second business, and that's property investment. And he is willing to pay for a range of very experienced and qualified consultants in all those different areas of expertise to inform his decisions as a property investor. And he's got a portfolio of over 40 properties. Wow. And he's used our information to choose the location, but he's used all these other experts to on topics such as what entity should I be buying in, and experts on depreciation, so they can maximize those tax deductions. All those things are important, but being willing to invest in that is a distinguishing feature of people like that who are very, very successful, as opposed to those who get stuck on just one or two. And of course, one of the other reasons that people get stuck on the first one and never progresses is the first one's a bad choice. If you get the first one wrong, it's very hard to move to the second and the third and the fourth.
Correct.
Because, if you buy a property that loses value and you don't have any equity, it's hard to go to a lender and borrow for the next one.
And similarly, if it's costing you a lot in cash flow, it's going to hamper your ability for own borrowing capacity as well, right? So you've always got that challenge of equity and borrowing capacity and servicing.
The people I know who give really good advice to property investors, that they stress the importance of getting that first one right.
Yeah.
And make sure you get it right. You need to be willing to invest in good advice and good information to give yourself the best chance of making that first purchase a really successful one. And that will allow you to leverage the second one and then the third, and then you're on your way. If you just keep replicating that process of accessing good advice and information and making sensible choices and being willing to make decisions, there's this new acronym out there similar to FOMO, which is fear of missing out. The new one is FOBO, fear of better options. And a lot of people get stuck on paralysis by analysis, where they can't make a decision to buy because they're afraid that, it's not the absolute best property that they could find, or not the absolute best location. I often say to people, look, there's no one right answer to where's the best place for me to buy. There might be 12 really good answers. Choose one and go for it. Don't try and, don't agonize over finding the absolute perfect best one, because it doesn't really exist, and you'll probably miss opportunities while you're doing it.
Yeah, great advice. Thanks very much. We had a listener question, and this is originally how we contacted. We got in touch with yourself because they mentioned your name, and so I'll take you through this question. And for those listening, we'll pop this into the comments as well. So there's a lot of talk in the market around people investing in residential or commercial within their SMSF, so self-managed super fund, especially those who are in their 40s and have hit their borrowing capacity ceiling under their personal structures. There was an interesting webinar with Terry Ryder and Andrew Courtney discussing residential investments within SMSF and how couples with the 250K income in 250K in super can potentially buy 2 to 3 investment properties, capital growth focused, and then use the opportunity to sell off these investments at pension phase to either downpay their other investment portfolio or their primary place of residence. Obviously, some limitations is you cannot take out equity, no developments, there's caveats around that, and cannot claim negative gearing benefits. But I see the temptation if you have, say, 400K in super and leverage to buy 2 investment grade assets, say for 800K each, and holding on to them for the next 20 years. Also, if you're in a high paying job and both couples are maximizing the 27K super contributions per year. On the flip side, you have the ability to invest in a good commercial grade asset, circa 1.5 mil, with multiple tenants at a net yield of 5 to 6%, which is diversification, and also benefit from decent capital growth. So there's a question in there, but it's really around, you did your seminar, those SMSFs are a great vehicle. So sitting underneath that is, what are your thoughts around SMSFs? Who is it right for? Commercial property, and then ultimately diversification as part of a strategy and a portfolio building phase as well.
Yeah. There's a whole 3-hour discussion in what your that person has written in. I have to say that the webinar they're referring to, I wasn't actually the expert in that field. My guest was Andrew Courtney, and he's a bit of a specialist in that field, but presented a number of options. Nevertheless, it's something that I've done myself. Quite a few years ago, I was very disappointed in the results of my superannuation with one of the big super funds. I felt like I was being charged a lot of fees, but I wasn't getting a lot of growth. In some years, the value was going backwards. So I decided to pull out my money and create my own self-managed super fund and put it into real estate, and done a lot better. And I'm sort of at that age when starting to think about pension phase and selling some of the assets, etc. But it can work very well. There are issues, of course. There are limited borrowing options. The major banks don't want to know about the space. Initially, they were in it and then decided it didn't work for them. So you've got to go to sort of second, third tier specialist type lenders to get finance. The interest rates are higher. You do need high yielding property to make it work, and that those options exist. It is one reason why people do think in terms of commercial property when buying real estate assets for their self-managed super fund, because one of the characteristics of small commercial is that you get much higher rental yields typically than you do with residential property, and perhaps less in terms of capital gains. But as a generalisation, I know people who've done very well with small commercial investments and getting fantastic cash flow because the rental yields are so much better. There are also specialist type real estate that does yield much higher than your traditional house on a block of land or apartment, like co-living type arrangements where you can get much higher rental yields, and SDA property where you can, if you get it right, you can get 12-15% type gross yields. Those sorts of products might be suitable because of the high yields for a self-managed super fund situation, but they are specialist property, and they are things more than any other where you need to get really good expert advice to make sure you do it right. Yeah.
I mean, we're talking about the asset selection. It's not a one size fits all model. It's going to be suitable for everyone. Different income brackets, for example, the maturity of an investor, where they are in their journey as well. Have they hit a cap in their own personal borrowing capacity? And a big part is when we're talking SMSFs, it's the balance that they've got that ultimately will determine what they can actually afford to buy and the quality of that asset as well.
Yeah, there's no one right way to go about real estate investment. There's so many different ways, and what's right for the individual will depend on their age, their family situation, their risk profile, their personality, which feeds into their risk profile, their income, and their ultimate objectives. I keep getting asked more than anything else, where's the best place to buy, as if there's one right answer to that question. Of course,
there's a challenge behind that, because you've called your name hotspotting and everyone's asking where's the next hotspot. That's a challenge. Yeah.
But my point and the answer I give people is that there's no one answer to that question. There are lots of hotspots. What's the best one depends on the individual circumstances. You might have 12 people in front of you asking where's the best place to buy, and there might be 12 different answers. And you'd only know the answer by asking each of them questions about themselves, maybe questions they haven't asked themselves of themselves. That's one of the problems, I think, is people haven't really thought about, where am I trying to get to? What's my end game? And therefore they don't have a strategy. But people who do that, my objective is to retire by the time I'm 50 perhaps. How am I going to get there? Well, I've worked out I need to own a certain amount of real estate, and this is what I'm going to do. Here's my process. Some people, it might be buying property where you can add value, that needs renovation, or there's sufficiently large block of land where you can build a second dwelling or a granny flat perhaps. Others don't want that strategy. They just want maintenance-free set and forget, and there's all sorts of other options. But it's important to understand, what your strategy is. One of the problems a lot of people have is even when they have a strategy, okay, this is what I'm going to do, and suddenly something bright and shiny over there will pop up and they get distracted by it. And they're talking about buying, a high-rise apartment on the Gold Coast. And I'm saying, but this is not remotely within the scope of your strategy that we've talked about. Yeah. This is just so off game. Why are you even wasting time on this? Because it's not going to get you to where you want to get based on all the planning that you've done. So therein lies another problem that trips up a lot of people.
Yeah. Yeah, well said. I mean, we mentioned about your business hotspotting. So take us through. You do some reports. So you go deep dives on market reports, for example. You offer the education, the mentoring, for example. You guys run consistent webinars and seminars. Take us through a little bit behind the scenes of what happens at hotspotting, Terry.
Yeah, we do have a range of services, and we've evolved increasingly into providing more and more B2B type services, like products and services for real estate professionals. And we lean perhaps a little bit more towards that than B2C, mum and dad investor services. So we've got reports, we've got memberships, we've got one-on-one mentoring or one-off strategy sessions. We can create custom reports for businesses. They've got a project in a certain area, they want a location report that explains the benefits of that area. So every day the team is scouring for information that informs our reports. We're looking online, various sources that we go to every day, looking for scraps of information. It's quite a labour-intensive and time-consuming process, but it's worth doing because one of the things we're looking for is any indication of new major developments, particularly infrastructure developments, that are going to have an influence in an area. If there's a proposal to extend rail links to an area that hasn't had it before, that's going to have an impact on their property market. They're going to build a $1 billion hospital in a regional centre that desperately needs it. that project is going to create a lot of economic activity and jobs. And once it's finished, it's going to create even more jobs in the running of it.
Yeah.
So we're looking for all those kinds of clues to areas that have action that might cause them to outperform in the future. And we gather all that together and we distill it into readable reports. And the idea really is to take the legwork out of it for people, because most people just don't have the time to do what we do every day because they've got day jobs and they've got families.
Yeah.
So the idea is to make it easy for them. So you don't have to do all that research. And we've done it for you. We've put it into a report where you can spend 10 or 15 minutes reading it rather than 10 or 15 weeks gathering all the information yourself and then trying to make sense of it. So most people probably don't even know where to go to get the information that's pertinent, let alone how to make sense of it.
Beautiful.
And that's what probably we like to think that's our point of difference, because you can go to other research houses and you can get lots of charts and graphs and things with lots of statistical information. But what people struggle with is understanding what it all means. And that's what we do. We take the time to write a report that explains the significance of all this information and to make some choices about, recommendations about areas that might be good for people to focus on.
Yeah, that'd be great. So if you are keen to check out the team at Hotspotting, we'll include links to your website. We'll include links to if you want to make contact with Terry and his team as well, particularly around that strategy. I mean, we always advocate for a strategy first, property second type approach as well, which I'm sure echoes what you guys are trying to do there as well. So most people buy the property first, and then exactly what you're saying about the Gold Coast unit there is, what and why did you buy that? And like, I don't know, it seemed like a good idea. It's like, well, hang on, let's go upstream a little bit. What's your strategy? What are you looking to achieve? And then design the process, as opposed to reverse engineer the process for someone that's already bought a property to retrospect their game plan.
So important, isn't it? To actually, we've got a report we call it's the 8-step Ryder property investment system.
Yeah,
and it's 8 steps. And step 7 is looking for something to buy. But most people start at step 7.
Yes.
They get excited and they start looking online for something to buy. And they've neglected all these really important preliminary steps, like thinking about what their end game is, developing a strategy, talking to experts, understanding risk profile, and finding out about their borrowing capacity. They can waste a lot of time looking at $1 million property before realizing that they actually can't afford to buy a $1 million property. So it's really, really important to do all of that. And that's a characteristic of the people who do succeed.
Do you reckon we get a copy of that model and share that? Is that possible for us to do that?
Yeah, it's I can certainly send you a copy.
Yeah.
It's one of those reports that we like to get people on our database, like a lot of businesses.
Yeah.
We have a range of memberships. We've actually made a number of changes and innovations with our website in the last few months. We've been working on it for much longer, of course, but we've finally launched with different memberships with different prices, entry-level type memberships, and then much higher level memberships for more serious people or for property professionals. We have a research portal where people who are members can go and they can get a whole lot of assistance. They can research any location in the country, any property in the country, to get a value estimate, for example. There's calculators there. There's a news feed, which we're updating several times a day. All of those resources are there for people to use, depending on which grade of membership they're on. But that report will refer to as part of that.
Okay, great. What I'll do is how about I put us on the spot here, and one of those entry-level memberships, why don't we jump on and we'll pay for one. So if you're a listener and you want access to this, drop us a message or drop us a DM, for example. The first one in, we'll work a deal with the team at Hotspotting. We'll shout someone a membership there as well, because we're all about trying to get investors matched up with the right partners, high quality, high caliber information. And if we can be facilitators for that, we'd love that. So we'll get speaking to Terry about some options there as well. If you're a listener trying to get into the portal as well, we'll include details for their website.
Okay, sounds good.
Awesome. Thanks very much, Terry. I really appreciate it. I look forward to getting back on the show and hearing, as 2024 unfolds, how it looks for the market and what you think the future has in store for property investors as well. So thank you so much for your energy. Thanks for your time and sharing your knowledge as well. Really appreciate it.
You're most welcome. Always happy to come on and have a chat about real estate.
Excellent. Thanks very much. I hope you've loved that episode. If you have, feel free to leave us a review or subscribe as well. But better yet, share this episode with a friend who you think may benefit from hearing this type of information as well. It does wonders for amplifying what we're trying to do here at the Australian Property Investment Podcast. That's a wrap, and we'll talk to you soon.